Hi, I'm John Prasinos, Editorial Director of Investing Daily, with a video presentation for Monday, March 6. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. We've enjoyed a powerful stock market rally in recent days as investors look past harder than expected inflation and Federal Reserve tightening to focus on fourth quarter earnings beats from bellwether companies. The year so far has been marked by volatility in both stocks and bonds. Stocks surged in January, slumped in February, and surged again last week. The major U.S. equity indices closed sharply higher on Friday, March 3rd, as you can see here. For a wrap-up of the entire week, take a look at the following chart. The S&P 500's year-to-date returns have fluctuated from 9% earlier in the year to 5.4% as of market close March 3, for a pullback of 3.6% from recent highs. Most impressive has been the tech-heavy NASDAQ's rebound as investors pile back into interest rate-sensitive growth stocks. The benchmark 10-year Treasury yield has stayed below the key 4% threshold. International stocks have performed well too. Energy prices rebounded last week as China's economy showed signs that it's emerging from its COVID lockdowns in robust shape. The world's second largest economy is the world's second largest importer of crude oil, after the European Union. The European Union's economy in particular has shown unexpected resilience despite the disruptions of the Russia-Ukraine war. The fighting has intensified in Ukraine, with heavy losses on both sides. But the Western alliance has held firm, and major economies on the continent, such as Germany, have found alternate energy supplies. The big question, of course, is whether we're witnessing a fear of missing out, FOMO, rally, or an upward trajectory that's sustainable. Much of the answer hinges on Q4 corporate earnings. For Q4 2022, with nearly 100% of S&P 500 companies reporting actual results, 69% of S&P 500 companies have reported a positive earnings surprise, and 65% have reported a positive revenue surprise. For Q4 2022, the blended earnings decline for the S&P 500 is minus 4.6%. During the months of January and February, analysts lowered earnings estimates for the first quarter by a larger margin than average due to worries about a Fed-induced recession. Looking further out, 10 sectors witnessed a decrease in their bottom-up earnings estimates for calendar year 2023 from December 31 to February 28, led by consumer discretionary minus 6.3%, materials minus 5.7%, and real estate minus 5.7%. The consumer staples sector was the only sector that recorded an increase in the bottom-up earnings estimate for CY 2023 during this period, a reflection of economic anxieties. For the equity rebound of early March to have legs, this trend toward downward earnings revisions would need to bottom out. We'd also need to see Fed policy getting less hawkish. Wall Street's forecasts currently call for 3 additional rate hikes in 2023 at the March, May, and June meetings of the Federal Open Market Committee, FOMC. These rate hike expectations would bring the federal funds rate to about 5.5%. The Fed funds effective rate currently hovers at 4.57%. I expect the Fed to pause rate hikes by mid-2023. Keep in mind, interest rate increases have a lagging effect on the real economy and consumption. We'll probably start to see these disinflationary effects in new economic data. Now, let's take a look at the week ahead. Economic data scheduled for release in the coming days could provide an inflection point for stocks. The salient reports include factory orders Monday, Fed Chair Jerome Powell's testimony to the Senate Tuesday, ADP employment, continuation of Powell's testimony, job openings, and the Beige Book Wednesday. Jobless claims Thursday, and the U.S. unemployment rate Friday. Frankly, Powell's testimony in Congress makes me nervous. It's usually a minefield for the market when Powell starts to speak off the cuff. He's likely to get flack from both the right and left of the political spectrum. However, if we see signs in Friday's employment report that rate hikes are cooling the hot jobs market, Wall Street might, just might, stage a relief rally. In the meantime, if you're looking for growth opportunities that won't get whipsawed by the risks I've just described, consider our premium trading service, the Weekly Cash Machine, helmed by my colleague, Dr. Joe Duarte. Dr. Duarte leverages a fear-based algorithm that uncovers instant cash codes that generate extra income regardless of geopolitical events, monetary policy, the path of inflation, or other adverse macro trends. In fact, Dr. Duarte's methods actually thrive on market volatility. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks so much for watching, and if you have any comments or feedback, please don't hesitate to send me an email at mailbag@investingdaily.com.